evening and welcome to Money Matters. My name is Jim Butler with Videre Wealth Management, and my co-host tonight is Dave DeWitt of DeWitt Capital Management. Hi, David.
Jim, good to see you.
Good to see you. Well, interesting times that we're living in.
We are.
12 months ago, 18 months ago, we thought the energy market was going to fall apart. It certainly seemed like price of oil was tumbling.
Yep.
We didn't know what was going to happen in the Middle East. Today we have a different story.
Yeah.
Even though we don't want to date the conversation and the timing of this show, certainly the price of oil has rebounded to some extent.
Yep.
And the outlook for energy is much different than it was maybe even as recent as 6 months ago.
Yep. Well, if you put it in a longer term perspective, oil 24 months ago was trading around $100 a barrel. The market was being oversupplied at the time, but there was always sort of like a terror premium, or what happens if supply is cut, and then what happens to oil prices. And so it kind of was lifted by that. And then OPEC in fall of 2014 didn't decide to cut, and then it was all downhill from there pretty much to a bottom in January or February of $26.50 for Brent, which created havoc in all sorts of areas. Exploration and production in the United States basically didn't grind to a halt, but a lot of those companies went into bankruptcy. And I know that the social cost for drilling for oil in the Mideast is up around $80 to $100 a barrel. They've got to support their population with the oil revenue, so they're in trouble. Those countries either are or have been or will be, experiencing difficulties. And Venezuela is in chaos. Nigeria is having civil war that could cut off supplies. Who knows? I mean, these ramifications of lower oil prices have wide-ranging effects. So then, and then when prices are low, people stop investing in production because it doesn't pay. So then the actual amount of supply is diminishing. And surprisingly, the one country that's really picking up on demand is India. India's growth in oil is up by about 14% year over year. India is an up-and-coming country, a youthful population. They want to drive cars. They really have a huge demand. It's going to supplant China as the next area of growth for oil.
So they have a demand need.
Oh, yeah.
They aren't necessarily a supplier. It's not like they're oil rich, but the demand is going to obviously be directed to them.
Yes. Yeah, India is a rapidly growing country, and luckily it's a large democracy, largest democracy in the world, offsetting China and Russia, which aren't really. Russia may be in name, but not in practice. So you have a very large democracy, very large population, very youthful, and the demand is going to be continually rising from there. And meanwhile, China's been hoarding oil while the price has been low and filling up their reserves, trying to do it as much as they can while the price has been low. And meanwhile, very little new supply is coming online. OPEC is going full out, to try to produce. They can't really raise production much. So we're in an inflection period.
So what position do you think the United States should take with regards to the production that's really increased over these past few years? Should we continue in that direction as a country?
It's that's really up to the individual, company that's producing the oil or natural gas. So when prices are low, they cut production a lot because it just didn't pay to do it. So the rig count in the United States went from like 1,700 rigs, actual drilling rigs, to just around 300. I mean, it was a dramatic reduction.
I'll say.
The fortunate side of it is that the technology's gotten so good for drilling in the United States that they've been able to keep production pretty much fairly close to where it was at peak. Like 9.7 million barrels a day may have dropped to 8.7 million barrels a day, but with far few rigs. When it comes time to oil prices rising again, when it comes to bringing back the crews that were abandoned, to bringing back the equipment and putting it in place, to believing that oil is going to stay high for a while and not just bring in production and then have it drop back down again, because that's what happened last year. Price went back up to 60, they all went back out to work, and then just the price plummeted. So oil production in the United States is going to be slow to recover even with higher oil prices. So again, the supply of oil is going to be constrained, but the demand is going to continue to rise. So this year we're kind of in an inflection year where the demand is going to come up, and it's going to exceed the supply, and then you'll see prices coming back up.
So how would somebody in our audience potentially invest in a smart way in either oil or, more broadly speaking, the energy sector?
There's a number of ways. You can buy any of the major oil companies, the Exxons, the Mobils, those type of companies that are big oil companies that pay good dividends. Or you can spend your money on some master limited partnerships, which the price of which, they pay out regular steady distributions that generally go up every year. But they were characterized as oil. So when oil prices declined, the price of the master limited partnerships declined right along with oil, even though they kept paying out distributions and in many cases raising them. The mindset on Wall Street, it was like chaos, and the price of these MLPs just collapsed. So now you can get the same thing that paid $1 and you paid 10 for it, you can pay 5 for it. I mean, I'm just giving you round numbers. I'm not suggesting anybody make any investment decision based on what I'm saying, but I'm just saying that the correlation with oil and these MLPs, which pay out regular distributions, seem to come to almost a 1-to-1 correlation, which was surprising.
I heard you use the term chaos on Wall Street. I've never heard that before.
Well, it was chaos. I mean, in the master limited partnership world, which I occupy, it became chaotic because of this mentality that oil and MLPs were the same. MLPs are transportation companies for the most part, or processing companies that are processing or moving oil and natural gas. They do that in ongoing business, whether oil is high or low, or whether natural gas is high or low. So overall, they continue to pay out these ongoing distributions. But the price of them came down with the price of oil, despite that. Now, there's a few on the exploration and production side that are labeled MLPs. Those ones went bankrupt. So that gave the whole world, that whole sector a punch in the eye, black eye.
Yeah.
So I think, generally speaking, the way to play a recovery is you can buy oil, you can buy large oil companies, you could buy master limited partnerships, there's a number of ways you could do that. But I think it's something people should be looking at.
And have a long-term view
Long-term view.
Knowing that the price of oil will continue to fluctuate in our lifetime.
Oh, yeah.
It's not going to go up and stay up there.
Yeah. Nobody really knows. I mean, it's again, if you want continuing income, then there's certain ways to do that. If you want to just purely, trade oil, that's a whole nother ball game. That's like traders do that.
Right. Well, let's shift gears a little bit and answer a question from one of our viewers.
Sure.
And that is from James Wilson in Ardmore. He writes in, David, for a retired person, what are some good tax-free investments to make for the long term?
Well, I mean, the first thing that comes to mind would be municipal bonds. That could pay, well, on a relative basis, a low yield compared to what they have in the past. We've had a long-term bull market in bonds that is, at some point, is going to reach its, peak. So if you're investing in municipal bonds, I would be careful about your maturity dates, and make sure that you even may want to really work with a consultant, somebody who really knows that market, to try to get into it as things are changing. Now, we don't know if interest rates are going to stay low forever. They someday may start to go up. And if you buy a municipal bond, you have to be careful that the value of the bond doesn't decline, because when bonds decline, generally speaking, when interest rates go up. So, I mean, the best way to get tax-free income is municipal bonds, no question about it. But you're not going to get the kind of yields maybe you could have, many years ago.
Sounds like maybe a laddered bond portfolio of individual bonds versus a mutual fund might be a way to offset the interest rate risk.
Yes. The alternative to that is where I work is in the MLP world. Most of those distributions are tax deferred, so about 80% of the distribution that you receive is tax deferred. It won't even go on your income statement on your tax return. So, and you can defer that tax for a long time. It's not tax free. The only way it would become tax free if you held it in your state when you passed away. Then all the deferred tax that would be due would be eliminated. The heirs would get brand new shares with no tax liability. So that's not tax free, and as we've seen lately, a lot of volatility in that market, but does provide steady tax sheltered income, not exactly tax free.
Right. Well, I think that answer is pretty straightforward. And unfortunately, in the current IRS code, there aren't a lot of options to address specifically tax-free investments for the long term. But we touched on a very viable solution. And if you have a question that you would like answered, please feel free to write in and communicate that to us.
Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our hosts and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Our guest tonight is Brent Byrne with Divi-Vest Advisors in Bryn Mawr. Welcome, Brent.
Thank you.
Hey, Brent. Good to see you.
Good to see you, Dave. Welcome.
Welcome.
Thank you.
So I understand that one of your areas of expertise is in dividend-paying stocks. And this is an area, certainly, that investors have heard a lot about over the past few years, certainly longer than that. But why does it seem, Brent, that investing in dividend-paying stocks has risen to the top of the list for investors again today?
Well, probably front and foremost would be the fact that, there's not really a lot of yield out there in the bond market. And it's forcing a lot of people into this area of stock market investing. But as far as the importance, all you have to do is look at the total return equation that every money manager has to succumb to, and that is growth plus income less expenses. There are some firms that would focus primarily just on expenses as a means to deliver performance. For instance, Vanguard is a big proponent of chopping away at the expense side of the equation to increase performance. My track of thinking has always been since 1991 that if you want to perform in the stock market, you have to pay attention to the math that decides total return. And for that reason, our focus has been on the dividend component. Certainly, we can manage expenses very, very effectively, and the growth side to the equation, in some instances, can be a coin flip, because no one really knows exactly what's going to take place in individual stocks day to day.
Right.
So focusing on the yield component has allowed us to outperform the stock market since 1991.
So is what you're suggesting that by focusing on the yield component that the growth piece almost takes care of itself over time?
Well, we can't control the growth. We think we can, but in reality, there's a lot of guesswork from our vantage, from our philosophy of investing. But we can control what stocks we invest in, and generally we're looking for high dividend paying stocks that are paying more than the average.
For example?
For instance, today I'm buying a company called Potash, POT symbol, New York Stock Exchange, based in Saskatchewan, Canada. Fertilizer company. The stock is way off its high, almost by 50%, paying close to 6%. If you believe that at some point in time there's going to be a recovery in this commodity complex, why not invest now while it's paying you to wait and earn a very lush return in lieu of that turnaround. Other companies we're buying today, which are controversial. Of course, everything we buy today is controversial if you're buying high dividend, because high dividend means low price. Otherwise, you'd be looking at an average paying stock with an average price. I'm not sure if you understand that, but
sure.
High yield.
Well, how would you explain that to somebody coming in off the street, just in real basic terms?
Basic terms, we start with the math that decides total return. Everybody has to answer to it, and so the value of looking for high dividend paying stocks increases that component of that equation, which gives you a natural advantage against the market. So that would be the simplistic way of looking at things. But other stocks we like are in the teen retail space, like Abercrombie and Fitch and American Eagle Outfitters, even Guess, way off their highs, paying great yields. And at some point, the retailing business will improve. All at this juncture, at the time we're filming here today, they're pretty much all in the tank. From the whole internet versus mall trade-off and standoff that we're.
Right. Yeah. How does that fit into your equation when you're looking at buying retail operations operating within a mall when you've got the internet and Amazon?
Well, we look for companies that own their brands.
Yeah.
Okay. One of the problems is with the department stores. They just don't own their brands, and their brands can be bought online.
Right.
And all of a sudden, they're in competition with groups and entities that they formerly weren't in competition with.
Yeah.
But companies like American Eagle Outfitters and Abercrombie and Fitch, which owns Hollister, as well as Guess, they own their own brands. So it's really opportunity for them from our vantage point. But again, you'd probably want to be in a diverse basket of stocks, and I would caution against buying individual stocks.
Yeah. So the ones that have the name brand, and they may have a store, but they also sell their own name brand.
Right.
That name brand could be sold over the internet or through the store. So they've got legs, whichever way.
Right. They have a different set of market forces in their favor versus the department stores, which I would be wary of investing in, even though I like the price metric, being so favorable today because they've fallen so much. Macy's has dropped from $60 a share towards $30.
Yeah.
But they don't own their brands, and that concerns me. How about the future outlook for the dividend payout for some of these companies? Take Potash as an example. Any concern for continuing of them being able to pay that dividend?
Well, there's always a concern when you're investing in high dividends, high dividend paying stocks, that there could be a dividend cut because of bad business, and it's just a risk you have to assume with this brand of stocks. But in a diversified portfolio and factoring in other elements to the investment equation, such as payout and how much debt the company has on the books. And for instance, American Eagle Outfitters has zero debt, as well as Guess, and Abercrombie has very little. And their payouts, are elevated because, but that comes with the territory with investing in high dividend paying stocks.
Right. What in your portfolio? Do you manage a fund or separately managed accounts?
Yes, separately managed accounts for institutions as well as individuals, starting at $250,000 an account. So it's for the more well-heeled individual investor. Below that, you might take a look at some of the mutual funds out there that concentrate on in the value space, paying high yield.
How many individual stocks go into a portfolio?
Well, with my all-cap portfolio, we have currently about 25, and it ranges between 20 and 30 positions. And my blue chip account, we currently have about 12 stocks. But they're very huge, large companies like Procter & Gamble and Microsoft and Intel and IBM, General Electric, these types of companies. It gives you a degree of safety. However, with the all-cap, you have the potential to, do well. Since inception in 1996, we've beaten the market by, at average, 20% a year. The S&P 500, and in the blue chip since 1991, we beat the S&P 500 by an average 3% a year. after fees. And it's interesting to point out, and I made a mental note to mention this, is if you invested in 1991 in the S&P 500, you would have averaged 10% a year.
Not a bad return.
Which is fantastic. Okay,
Yeah.
that's equivalent to a $100,000 home being valued at $1.2 million today. Okay, versus that $100,000 home probably being worth $250,000. Okay, so the advantage to investing in stocks cannot be doubted. It is clearly a place to be long term.
Brent, an appropriate question, since you manage money, is why do so many active managers, in your opinion, have difficulty beating a number like that?
Well, there are those that do beat the market by pretty wide margins,
Right.
and some of those they might take a little bit more risk by concentrating their portfolios down to maybe 4 or 5 stocks.
That's complicated.
Well, but I think it's really a matter of the math, and I don't think it's rocket science. Okay, to outperforming the market, if you can find a way to maximize those component elements of the total return equation, I think that'll give you a big leg up in deciding your future performance.
Now we've had, since '91, we've had generally declining interest rates during this period.
Yes.
Which has driven people more and more towards dividend-paying stocks. So that's been, I'm sure, been a help, a tailwind.
Right.
In that regard. What happens? Or what is your outlook for interest rates?
Well, I think they only can go up.
Yeah.
They certainly can't go down any longer. Yeah. And but now we have political forces. I was just watching a commentator on one of the business shows this morning, and outlining, given the $20 trillion debt we have, that to raise it just back up to 2%, it would represent a $400 billion increase in expended outlays to pay the debt.
By increasing interest rates.
Yeah,
so you're talking about the federal funds rate? Are we talking about?
Yeah. It'll be a real tester, okay, for the Federal Reserve to politically go crazy like Alan Greenspan did. From 6 to 3, 6 to 3, 6 to 3,
Not going to happen.
through his tenure. But personally, I look at the equation a little bit different in that high rates actually cause inflation versus the conventional thinking that high rates curtail inflation.
Expand on that a little bit.
And I think if with the low rates that have taken place, we've had no inflation,
Right.
Essentially. So maybe the Fed, changes their whole modus operandi on dealing with inflation and realizes that maybe high rates are a thing of the past and have outlived their usefulness.
Well, worldwide, we've had just flooding the market with money
Yes.
and financing very subpar growth worldwide by just keeping adding liquidity to the market worldwide.
Yes.
So when the U.S. decides it's going to start to ratchet up rates, then the dollar goes up, and now you've got a policy in the U.S. that's counter to the rest of the world. They won't be acting in sync when that occurs.
Yes.
And I don't know what ramifications that has for things.
The rates can only go up from here. But I guess what I'm trying to say is I don't see them traveling north, at a ridiculous speed that would upend the economy or the prospect for investing in dividend-paying stocks.
So the hunger or appetite for the topic of what we're talking about, dividend-paying stocks, is going to continue for a while.
Yeah, it's always been with us. It dates back to Benjamin and Graham. If you're money managers, you're aware of the book that they wrote.
Right.
When you look at a dividend, when you're making your selection process in a dividend-paying stock, do you look more at the current yield or the rate of growth of the distribution?
Both.
I'm sure you do. Both.
Okay, yield. Certainly, you want a high-paying dividend stock, but you also want a high dividend paying plus growing dividend.
Right. Right. And where do you get your most of your return from? The ones that are growing in the fastest, or the ones that start off with the highest yield?
Well, I haven't really done an extreme analysis on that particular point, but it's a good question.
Yeah.
To look into. But generally, I like both.
Yeah. Nice to
but
have
it's guesswork. When you're peering into the future and deciding, can a company grow their dividend? Because there's all kinds of forces that can upend any prospect for dividend growth.
Let's talk a little bit while we wind down the show here this evening, Brent, as to how many stocks to hold in a portfolio. You have your sweet spot. You had mentioned in one of your funds 20 to 30 positions. Most mutual funds have many more.
Well, and statistically, with blue chip stocks, once you diversify beyond 10, the advantage from the next stock that you add into the portfolio really drops off.
Yep.
Statistically. So I think if you're looking at blue chip stocks, the sweet spot is 10. For smaller cap stocks, that endpoint is around 20 stocks. Where each additional stock that you add really just drops off and becomes meaningful.
Yeah.
But even that flies in the face of what most investors understand as to how to control risk. 20 stocks in
well, I think you have to do your own
portfolio?
due diligence, and you got to turn off the TV and close the textbooks and do your own research. And the more you listen, to the pundits, for instance, Jim Cramer, who actually was just written up that his trust is underperformed by a dramatic amount, the S&P 500, but he's king, You just have to do your own research.
Right.
And but the facts are the facts. Statistically speaking, once you diversify past 20 stocks with mid caps to small caps,
Yep.
you really don't get an advantage.
It comes down quickly, that advantage.
Exactly.
You're mitigating market risk.
But to get to your point, with mutual funds, you could argue if they're managing billions and billions and billions of dollars, they need to spread themselves out between 100 to 200 because it just would overrun the stocks that they would
Which
be.
would make it really hard to outperform it with that big a size.
Right.
Yeah.
Right. Well, interesting topics that we touched on. Again,
Thank you.
dividend stocks is been around for a long time, but
Sure.
I think it's as relevant and valuable today as
Absolutely.
any time, particularly as we go forward. If we look out over the next 5 to 10 years, I think invest in a diversified portfolio. Dividend-paying stocks is a very smart decision.
Thank you.
So stay tuned for our show next time. It's going to be Stephen Sweeb of Preservation Wealth Management. And Stephen is a wealth manager, and I'm sure he'll have some wisdom to share with you as well. And in the meantime, your money matters. Thank you.